This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, dollars and cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Why should I be invested? Why should I invest? Why should I stick to my plan? Does diversification and allocation really matter with all the stinking market ups and downs? We'll tackle all of that here on the program this morning as we go through a range of topics, all of which, given the market's recent behavior, are intended to keep you calm, to keep you cool, and most importantly, to keep you invested. This is Joel Garris of Nelson Financial Planning. You are listening to Dollars and Cents, Central Florida's longest-running radio program here on News Radio 93.1 WFLA, and simulcasting over to our good friends on the AM dial at 540 a.m. Those are the ways in which you can listen to the program live here on Sunday morning, or tomorrow if you wish to catch the program again, or if you missed a part of the program, or you want to tell a friend about the program. All you need to do is go to our website, which is, of course, nelsonfinancialplanning.com. That's nelsonfinancialplanning.com. And in the upper right-hand corner, you'll see a bunch of icons. Those icons include things like LinkedIn, Facebook, Twitter, iTunes, Google Play, and like 3 or 4 others that I'm forgetting right now. But depending upon how you like to get your social media delivered to you, you can click on the button and ultimately be directed to the radio program. So let's get started. One of the underlying concerns, or one of the underlying issues out there that many people forget along the way, is the simple fact that things cost more over time. Things cost more over time. That is fundamentally the definition of inflation, right? So let's look at 3 examples just to give you some perspective on it as to what that translates in terms of actual dollars, okay? Because ultimately what inflation does over time is it eats away at the purchasing power of your dollars. So if we look back over the course of the past roughly 50 years, you will see a phenomenon, whether it's gas, milk, or college tuition, although the phenomenon may be more pronounced in college tuition, but I don't want to digress on that topic. It never ceases to amaze me how much college tuition has gone up at a much greater rate than anything else. Anyway, how much has that change been? Well, we'll give you the numbers. So since 1970, gallon of gas cost you 40 cents. At the end of 2017, the average price of a gallon of gas in America was $2.48. 40 cents, $2.48. So to get the exact same thing, you need 6 times the amount of money that you did back in 1970 to get that gallon of gas. Folks, that's inflation. We'll go to the next example. Gallon of milk. Gallon of milk in 1970 cost $1.32 on average. At the end of 2017, said gallon of milk, $3.16. And if you're going for, the non-organic or the steroid driven milk, it's going to be even more than that. But $1.32 versus $3.16. So that would be, you need triple the amount of money to put on your cereal in the morning. And the last example, the cost of a public college tuition, 1970 was $351. Today, it comes in just under $10,000, $9,970. That one has gotten an inflation kicker plus profit-making or profit-oriented university and schools that have gone into academia. Again, don't want to digress on that topic, but the reality is, if we stick with the very simple examples of a gallon of gas and a gallon of milk, you need 6 times as much money today as you did in 1970 to get that gallon of gas, 3 times as much money as you did in 1970 to get that gallon of milk. Folks, that's inflation. That's inflation. And that's been going on since really the birth of the U.S. economy and, frankly, the birth of trade. Because if you look at how much things cost back when, and you compare them to today, that is this concept of inflation. Inflation creeps along at about 3% per year if you look back over the course of the past 80 years. So guess what? That means that 3% becomes your minimum threshold in terms of your needed rate of return over time. Because if you don't get 3%, you're not able to buy the gallon of gas. You're not able to buy the gallon of milk. Because ultimately that is the cost of inflation. So that concept that you don't hear a lot about, sort of hear it, kind of brushed in broad strokes. But the concept of inflation has to be one of the most important concepts when you're talking about investing and when you're talking about the need for a certain level of investment return over time. It's got to be better than 3%. Otherwise, you're drinking less milk and driving less in your car. Very simply put. So that's number one, a little perspective on that, if you will. Now, let's look at investing over time. Investing over time, if we go back 40 years, you see that $1 translated out on the inflation basis is basically $4. If you look at inflation, much like these examples we've been given back to 1970, $1 in 1978, today effectively it's $4. That's the power or the issue with inflation. If you look at cash as measured by the 3-month Treasury bill, which are the shorter-term treasuries, usually a proxy for cash, you will see that $1 invested is $6.30. Not really getting too far ahead of inflation, and in particular, if you were to look at these numbers over the past 10 years, the results would be even more dismal because over that period of time, over the past 40 years, inflation has run at about 3.5%. Meanwhile, cash rates have run at about 4.7. Now, remember, it's a 40-year period of time, so there were periods of time where their rates were much, much higher. The past 10 years, certainly, we haven't seen anything along those lines at all. In fact, that cash is losing to inflation right now, particularly over the past 10 years. We'll go to the next two categories of assets as to how best to fight inflation, because that conversation about how you fight inflation turns a lot into how you should be investing. We'll continue that here on the program, here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA, 540 AM WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. This is Joel Garris of Nelson Financial Planning. We're talking a little bit about some important concepts, particularly given the market's recent behavior. Staying calm, staying cool, and most importantly, staying invested. We started the conversation off with a very simple concept. It's the simple concept of inflation. Inflation, that means that I have to spend 6 times as many dollars to get the same amount of gas as I did back in 1970. I have to spend 3 times as many dollars as I did today as I did back in 1970 to get a gallon of milk. If we look at those returns or those costs over an extended period of time, we find that over the course of the past 40-odd years, inflation has run at about 3.5%. That becomes your bogey, if you will, your threshold that you've got to be making. Otherwise, you're losing. I don't care how secure you think your money is or how guaranteed your money is. If effectively it's generating only a 2 or 3% return, then you're losing money. You're not guaranteeing anything. Not preserving anything, because it's getting eroded every single day by the power of inflation. So now if you start to look at the differences in returns as we go up, inflation and cash, and then we look at bonds. Bonds, over the course of the past 40 years, delivered about a 6-7% return. Okay, that's starting to get a little bit better. Okay, if I'm going to be diversified, certainly want to own some portion of that. I would counsel folks, of course, over the course of the past 10 years, hasn't been anywhere near that. So that would suggest that I certainly don't want to be overloaded on that side of the equation. Again, what's my bogey? 3.5. That's inflation, and I got to at least be doing better than that, because just to stay ahead of inflation, let alone, okay, trying to generate out some income that ultimately increases over time as things get more expensive. And the last category, of course, is the category we believe in the most. Okay, why do we believe in them the most? Because it's hard to argue with long-term results. Been doing this for 20 years, seen a lot of ups and downs in the market, and guess what? There is no better alternative to investing your money and achieving long-term investment results than having a portfolio that is, in fact, or owns the majority of which in that portfolio is stocks. Yeah. Sorry, you're going to have to be a shareholder of Amazon. You're going to have to be a shareholder of Microsoft. You're going to have to be a shareholder of Home Depot. You're going to have to be a shareholder of Coca-Cola. Right? Wait a minute. When I own stocks, see, I think far too often people forget what it is when they have an investment portfolio. Because it is not in any way, shape, or form what those yahoos on CNBC are yibber-yabbering about 24 hours a day, 7 days a week. That's not it. Folks, That's a company whose business is advertising. That's how they make their money, by selling ads. It's got nothing to do with the quality of the financial guidance that they are espousing. It's a circus. It's akin to watching a sports program. That's what they've done to it, right? If you watch it, it's got the screen thing going on at the bottom, just like ESPN. They've got the latest score, the latest look-in, the breaking news alert, the time to when the next Fed rate decision is, the Bitcoin little box. I mean, come on. That's got nothing to do with helping you plan a retirement and achieving investment results over time. It's not. It's got nothing. It's the furthest thing from that. But yet, that's what we gravitate to. That's what we fix on. By the way, the return of stocks over the course of the past 40-odd years, right around about 11%. You tell me what you want, right? Goal is I got to do better than inflation. That's number one. Got to do better than inflation. Cash, just a little bit better. Not much better if you're looking at the past 10 years. Bonds, same thing. Remember the threshold that you've got to achieve over time. So if you're tying your money up in one of these fabulous equity indexed annuities that are still all the conversation out there, and every time the market goes down, you wind up hearing more and more and more about them. Oh, well, Mr. and Mrs. Jones, you're going to be put into a product where you get all of the upside of the market with none of the downside risk. Isn't that what you want? And boy, I'll tell you what, if that really were true on its face, absolutely go for it. The problem is it's not true. It's why that thing is sold with 50 pages of fine print. Because when you start to pour through the fine print, you realize that through caps, participation rates, and even how they measure the indexes, i.e. stripping out dividends, which, if you last checked, makes up about half of the long-term return in the market, that's the game that's getting played against you. Oh, and by the way, heaven forbid if you want your money, because, that's subjected to a 10 or 15-year-long surrender cycle if you ever want more than 10% out of that account. Do not. You're going to hear the more volatile the market becomes, the more you hear about that crap. We've looked at it. We've analyzed it. We've actually done a real study on it. And the long-term returns on that really should come as no surprise to you when you stop and think about it, because the product really is a glorified fixed annuity. It's pig with a little bit of lipstick. It's a fixed annuity generating an effective return that winds up being 2-3% over time. That's not a whole lot more than inflation. But boy, you're going to hear a lot about that. Oh, did I mention it's also the highest commission product in the business? Did I mention that? Usually pays about 8% commission, maybe 10, But don't worry, you don't have to pay that. Yeah, I'm not sure that's how that works. If the insurance company is paying the agent 8% or 10%, they're not doing that out of the goodness of their heart. It's funny, out of all the people have come in and said into my office and said, oh, someone was talking to me about an equity index annuity. Every single one of them I asked, did they tell you how much they were going to get paid? Not one has been able to tell me that answer. Stop and think about that for just a second. Not one. So much for the fiduciary standard in the industry, huh? Getting slapped into a product. Highest commission product, and nobody talks about it. Nobody mentions it. It's all. Anyway, digress. Okay, we're back. Listen to those long-term returns again. Inflation 3.5, cash basically 4, bonds basically 6, stocks basically 11. Okay, so that hopefully gets you thinking a little bit. Now, how do you put all that together? Well, that's where allocation and diversification comes into play. Okay? Yes, we're going to talk about those fundamental concepts here on the program when we get back. You're listening to Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. We're talking a little bit about how to stay calm, cool, and most importantly, invested in times like this. This segment of the program, we're going to talk a little bit about allocation and diversification. Yeah, shocking, dramatic concepts that ultimately have certainly withstood the test of time and are some bedrock principles that need to still be followed today, no matter what. It's interesting when you look at the different categories, and if you break them down, cash, bonds, global bonds, large cap value, which is more the dividend payers, large cap growth, international, small, mid, commodities, REITs, all of that stuff, okay, what you would find is if you tracked the performance on an annual basis, you would find that there is absolutely no clear pattern of one asset class over the other. Not in any way, shape, or form. However, by being diversified, you can, in fact, help to achieve a consistent return with a lower risk profile than the overall market. So let me break that down again. That's where allocation comes into play. Owning large companies, owning maybe some mid and small, maybe owning some bonds, maybe owning some international. Those types of concepts, when you look, are the way to achieving a well-diversified, well-balanced allocation. Now, what's the single biggest limitation of diversification? The single biggest limitation of diversification? That would be that not everything in your portfolio is going to be performing as good as everything else. That's the reality, right? Being diversified means at any given point in time, you have stuff that's doing well and stuff that's not doing as well as the stuff that's doing well. That's the reality. And when you look at your accounts, if you get too busy looking at the trees and not the forest, you start to say, my goodness, why do I own this particular tree right now? Because it's not generating as much as that particular tree. The purest example of that, particularly so far this year, would be this notion of large cap growth versus large cap value. Large cap growth, companies like Amazon, Facebook, Netflix, those types of companies. Large cap value being companies like BP, Procter & Gamble, companies that generally pay a dividend are not as exciting as a Netflix or an Amazon, and certainly don't get the kind of conversation in the financial media as Procter & Gamble, Home Depot. They sell hammer and nails and wood. How boring is that? Amazon, they deliver stuff to my doorstep in like 2 hours. That's really exciting. But guess what? When you look at the performance since October 1st of those two particular asset classes, you may be curious to find that more boring asset class has only gone down about 60% of what that more exciting asset class has gone down. Check it out. If you look at your investments that finely, you should see that pattern, whereby the large growth stuff might have gone down 8. Well, the large value stuff, that only went down 5. Diversification spreads my risk around. And at the end of the day, that certainly helps to produce a much more consistent return. Because when you look at how that plays out in terms of the numbers, after all, when you are retired, and here's the fundamental concept. When you are retired, the single biggest issue is consistency of performance. You really don't want to be hitting a home run one year and striking out the next. You really want a diversified portfolio of singles, maybe a double or two every now and then. That's the way to ultimately reduce down the volatility in your portfolio and achieve that investment result over time. Allocation, diversification, and from time to time, doing some rebalancing along the way also works as well. Rebalancing is if I've got stocks, bonds, stocks at 75, bonds at 25, and then all of a sudden my stocks are now at 65 and my bonds are at 35. You would rebalance, take 10% out of the bonds, shift it over to the stock side. The benefits of rebalancing cannot be understated. You've got to watch the numbers in terms of when that rebalancing needs to be done. Usually that rebalancing is good to do. Some folks like to do it every year. We like to give it a little bit more time than that. But the reality is that concept of reallocating assets along the way makes an awful lot more sense. Now, for those folks that are just starting out, remember, it is time in the market, not timing. I think one of the biggest issues that new investors have is they always wonder what's the best time to invest. And the hard part of that is that you're never going to be able to predict that. But understand how the rates of return work and the power of that time and how that plays into account. So there's a very simple math rule that's the rule of 72. You take 72 and you divide it by the rate of return, and that tells you how quickly that amount is going to double in value. Okay? So we'll play a little example. Going back to inflation, 3%. 3% divided by 72, that's about, or 72 divided by 3%, that's about 24. Every 24 years, inflation is basically going to erode 50% of your dollars. And if you think about those analogies of gas and milk that we were talking about at the beginning of the program, that's about what it looks like. If you've got a bond portfolio that's 6% return over time, then 6 into 72 is about 12. 12 years. If you've got a stock portfolio and you do that math, then that's about 6 or 7 years. You get the drift. It's really more when you're trying to build wealth over time, it's really more about time in and certainly not timing, because the power of that compounding, the power of that math plays out dramatically over a period of time. It really, really is a pretty significant difference and a pretty significant power of compounding that occurs over that extended period of time. Now, hopefully you've enjoyed a lot of these stats and figures, and now we'll get to the punchline, which is, why should I stick to the plan? Why should I stick to the plan when every other media person is saying, okay, all hope is lost? Here's why. and it's pretty important. And it deals with the inherent volatility of the market. And we'll tell you that right after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Talking a little bit about how to stay calm, how to stay cool, how to, most importantly, stay invested on this version of Dollars and Cents. Particularly important topic given all the conversation about the market that has happened over the course of the past, since the October 1st. Been a lot more volatility in the market, which obviously translates to a decline in the value of the market, and certainly that's getting a lot of talk and a lot of attention. We've gone through a lot of different concepts on the program so far, starting off with the very simple concept of inflation. Inflation becomes your bogey, if you will. Got to do better than inflation, got to do better than inflation on a regular basis. Inflation, past 50-odd years, running about 3.5%. That's your bogey. As you start to look at the other investment alternatives, one really sort of sticks out as having the better return over time, and that is owning stocks. Now, that's not to say you should own exclusively stocks. Having a diversified, balanced portfolio obviously makes sense, but be careful. You don't want to overweight too much on the cash and the bond side because ultimately you undermine your long-term results. The more you undermine your long-term results, the harder it is to stay ahead of inflation. That's the point of a diversified portfolio, is that not everything is going to be marching in unison. If you've got a portfolio where everything is trajectorying along exactly the same as everything else, then you don't have a very diversified portfolio. You've got to have different asset classes that at any given point in time, there's going to be some stuff that's performing better than the other stuff. It's the nature of diversification. But what you're doing there is you're helping to reduce the overall risk or the overall volatility of those numbers. Remember, time in, not timing, for those investors that are scratching their heads as to when should I invest or how should I invest. Those are certainly important questions along the way, and so that becomes a time in conversation. Once you have time into the market, then you have the power of compounding on your side. Now, why should I stick to the plan? Many don't. Many don't. Which is why when we talk about being a long-term investor, employing a buy and hold strategy that over time is rebalanced or diversified along the way, it sounds so simple in concept. It's just not sexy. They don't spend any time advocating this approach on CNBC because they'd put everybody to sleep. And nobody would bother to listen tomorrow, because if I'm going to buy and hold, well, then what's the point in dialing in and listening to those turkeys? Well, there isn't. The problem is they need you to listen tomorrow because they sold a bunch of ads that are going to run tomorrow, because that's the business that they're in. They're in advertising. So they need an audience in order to justify the cost that they charge clients to run ads on their network. That's the business that they're in. It's not an information-based business. It's got nothing to do with your retirement, and heaven forbid that they actually give you any level of financial guidance. That's not the point. Unfortunately, far too many people get distracted. We've certainly shared this number with you. If you look over the course of the past 20 years, You see market returns of around 9%. Unfortunately, the average investor over that same 20-year span only generates a return of about 3 to 4%. That means that the typical investor is only getting about a third to maybe a half of what they could have gotten had they employed a very simple buy and hold strategy. That's why there's so many people running around out there saying, oh, the market doesn't work. I only lose money in the market. You only lose money when you react to a decline to a headline. Because if you had been a consistent investor, you'd realize that, hey, there's times when I made money. There's times when I lost money. There's been a heck of a lot more times when I made money. And that certainly offsets the loss. But when you look at the numbers, it is amazing how poorly the average investor does in relation to the market because they cannot help themselves. They get distracted. They get distracted and they make a mistake, and those mistakes generally are very costly. Because when we talk about volatility in the market, we only think about volatility in a negative connotation. Volatility means I lost money. Volatility means market went down. No, that's only half the definition. That's only half the definition. Volatility also means that the market is going up as well. Now, you don't hear as much about those up days as you do about the down days. It's just the reality because, as my good friend Bud Hedinger has long told me, bad news sells better than good news. That's the reality. So you don't hear much about those up days, but they're out there. Remember, that's the other definition of volatility. Volatility, if you look it up in Webster's dictionary, if anybody has a dictionary anymore, probably not. Look it up on your phone. Look it up on Google. Okay, not Merriam-Webster, but go to Google and Google volatility. You'll find that it means up and down. Not down only, but up as well. Here's how those numbers translate. If you look at the course of the past 20 years through December 31, 2017, if you had invested $10,000 in the broad-based market measured by the S&P 500, if you invested $10,000 in the broad-based market 20 years ago, today, of that $10,000 investment, you'd have $40,000. Pretty good. Doubled it twice, right? 20 years, doubled it twice. Yeah, it hasn't been a perfect scenario over the course of particularly the past 10 years, including 2008, but you still got 7%. That's doing better than inflation, better than bonds, better than any other asset class out there. Okay, now, 20 years. Let's help me with the math. I got 20 years. There's about 250 trading days per year. Okay, make sure I'm actually doing this out by hand. 0, 0, 0. So that is 5,000 trading days in a 20-year period of time. If you missed just the 10 best days, and folks, here's the point about volatility. It's up and it's down and it's up. We forget about the up part. You missed the best 10 days, guess what? Your $10,000 over a 20-year period of time only turns into $20,000. That is half. It's half. So when you hear these studies of how the average investor doesn't do more than a third or maybe a 40% of what the overall market does, that's why. Because they get too caught up in the volatility of the down days and sort of ignore the volatility of the up days. And guess what? They're usually clustered together. They're usually kind of all clustered together. That's typically the pattern. Everybody remembers the single worst day in the market. Okay, Black Monday, October 19th, 1987. What they forget is the single best day was the next day. But there you have it. Missing only 10 days out of 5,000, your return gets cut in half. Miss the best 30 days? Well, so we'll go to 20. Miss the best 20 days, and your 10,000 only turns into 12,500. Say 20 days out of 5,000 days. When you look at these numbers, it is shocking how significant volatility works. or the effect that volatility can have, both on the downside and on the upside. Miss the best 20 days over a 20-year period of time, your $10,000 only turns into $12,570. Miss 30 days, 30 out of 5,000, guess what? You lose money. 10,000 turns into 8,332. Folks, that's the reason why you stay invested. Stay calm, stay cool, and most importantly, stay invested. The numbers are squarely against you. Don't forget, the concept of volatility works both ways, because if you only get fixated on the negative, you're sure to miss one of those positive days, and those positive days make up a huge part of the overall performance of the market. Hopefully you found the program useful. If you want to listen to it again, we'll post it on social media tomorrow, so you've got all of that to catch up on again. We're going to get out of here. This has been Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 93.1 WFLA.
This is Bud Hedinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.